This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil. So what I'm going to do today is talk about swing trading. I get a lot of questions about these types of trades, and I want to discuss the reality of the situation, that it's not always the best time to swing trade. But if you're committed to doing swing trading, I would suggest following these few ideas. I think they can help in this type of environment. All right. Now, if you want to learn some more about some of the technical analysis techniques that I'm using, I would suggest starting with the book. It's at rabilstockresearch.com/book. Also, if you do like this content, please hit the like button and also subscribe. So I've got the chart of American Express up. In fact, I've got my grid up. I did that on purpose because this is a monthly here, weekly here, daily upper right, and hourly in the upper left. Now, when I'm swing trading, I am focused on these two time frames here. I'm looking at the daily as the upper time frame, or the higher time frame, and the hourly as the lower time frame. So this is the trend time frame. Looking at, what do I like about this pattern, right? And I typically, when I'm swing trading, I'm usually looking at two types of trades. And I'll go into those in a second. But so I want to make sure that this is the time frame that has me attracted to it. I don't want to go to this one and then work my way back. I want to start with the higher time frame and then go to the lower time frame. And that goes for all the types of trades I do. I always start with the higher time frame and then work to the lower. I don't want to look at the trigger time frame first, because I can get enticed into taking a trade that might not look attractive on the higher time frame. And that's really the time frame that we were trading. All right. Now, what I'll tell you is that let me just make this simple. I'm gonna hit this here. All right. So first order of business is I'm looking for pullbacks to a rising moving average. All right. This is my go-to pattern. I talked about this not long ago in my subscribers. We did a webinar and I talked about day trading, and I said I'm looking for a pullback, to the 5-minute 18. This is the 18 on the 5-minute. I'm looking for a pullback. That's my go-to on an intraday trade. All right. And if I'm looking for a swing trade, I'm looking for a pullback on the daily like this. All right. And then I'm going to go down to the hourly and look for entry. All right. Now, there is another option there that you can look at, and that would be let's just say the weekly chart is moving up, but it's getting really stretched away from its 18. Okay. Now, it might have really good momentum, but it's gotten pretty far away from its 18 MA. All right. And the MACD is looking extended, and ADX might look a little overdone as well. It might be over 50 or something like that. And then if we go down to the daily chart, it'll be up as well, but it might be showing some sign of momentum divergence like MACD or ADX or something like that. All right. So that's the combination where we're up here on the weekly, and on the daily chart, we're showing divergence of some sort, potential divergence. And then I'm going to go down to the hourly and look for a reversal signal, which could be a 1, 2, 3 pattern. It could be another sign of divergence. Usually I'm looking for an ADX exhaustion signal or something like that. I want to focus just today, though, on the pullback trade. All right. Now, one thing I wanted to do, and the reason why I'm showing all 4 time frames, is that I can see that when I look at this is the last setup on the weekly chart. You see how we pulled back to a rising 18? Now, that is not a swing trade unless you're looking at it as an intermediate term speculative trade, which would last somewhere around a month, 3 weeks to 6 weeks, something like that. All right. If you buy the pullback to the 18 week, that's an intermediate term trade. If you buy a pullback to the 18 month, that's a longer term trade. If you buy the pullback to the 18 day, then I call that a swing trade. It can last, anywhere from a couple days to a couple weeks. So we have had 2 incidences of this, right? We had the pullback here in November, which was very orderly, and I'll show the entry on that and everything. And then we had this pullback here. All right. Both were pinch play setups. All right. Now, this one's showing a little bit more strength. This one didn't show quite as much strength on an ADX basis, but it had a nice DI breakout, all right, which is good enough in this situation. So if we go to the hourly on both of these trades, let me go back to November. You can see the November setup where it comes down and gives a really quality, in fact, 2 back-to-back pinch plays. Either one would have been an acceptable entry. And the ADX didn't get above 25 during the decline phase. We had a little spike. We had a little undercut and rally pattern. There were a lot of good reasons why this area here was a great spot for a swing trade. Now, in this environment, and goes all the way back to November, I think where the volatility started to increase. So the way I'm handling this, all right, is not to just take the stock trade, not necessarily looking to trade stocks. What I would do is figure out how much money I would put in a stock trade. So if your account is $100,000 and you risk 1% of that, that would be $1,000. And that's how much money you would risk in the trade. So you figure out how many shares you would buy based on how much risk you're taking to when you get stopped out, based on where your stop would be, then you'd lose $1,000 if you were wrong. All right. What I want you to do is take that $1,000 and put it into an option trade. All right, instead of doing the stock, do it in the option, and I'll explain why. Now, what we've done by putting $1,000 up in the option is that we have created a stop loss that cannot be exceeded. All right, we can only lose the money that we've put up. So if I've put up $1,000, I could lose the $1,000 if we get a big gap down. All right, but that is the max I would lose. If I do a stock trade and we get a big gap down here and my stop is here, I'm losing all this additional loss. Now, I'm not losing one risk unit. I might be losing 2 or 3, something that's exceeding how much I want to risk. All right. So what I would say is if you do the option, then you're risking only 1R every single time. Now, the numbers can work if you do that. It's where you do stock trades and you're losing 2R sometimes, 3R sometimes, 2.5R, 1.5R. Those numbers start to make it very, very difficult to make money over the course of 20 to 25 trades. Or if you're doing it, over a longer period of time, if you're doing 500 trades or something like that, it's just going to hurt the numbers pretty significantly. So if we do that, and then in the environment we're in, if you just play for 2 to 1, so if you get 2R, you take the full amount. All right. So in this case, you would have, if you did this, you would have been out like here. You would have only been in for maybe a day or 2, and you would have taken the profit. You would have missed this part, but you would have had a good profit. 2 to 1 is a good profit when you're trading. Okay, that's really, really good. If you can come anywhere near 50% win rate, then doing 2 to 1 is going to be exceptional. If you can control the risk side of the equation. The way you control the risk side of the equation right now in swing trading is to do options where you only risk how much you would risk in the stock. So I know I'm only going to lose 1R. All right. Can you get 2R? That's the goal. So you get 2R and you're out. All right. Now, if we go to where it might not feel all that great because you've given up a little bit of profit here. If we go to the most recent setup, you can see that we had a pretty nice reversal pattern develop. We got the 1, and then we came back and formed the 2, and you could have easily been in the trade here for a stock trade. And I don't believe you would have hit a target here. Target would have probably been more like here. And now the market's getting killed today, and this is somewhere down in here. You're likely going to get stopped out. All right. So the question becomes, do you only lose 1R, or do you exceed 1R and end up losing 1.5 or maybe 2 or something like that, because we're getting a big market gap down? If you do the option here, then you only lose 1R. All right. So it makes the numbers. So that would mean you got 2R on the trade in November, and you got, lost 1R here. You're still up 1R. Okay. In an environment that's not that great for swing trading. Now, I think what I mentioned about trading intraday was, just go through and look at the Dow stocks. You can scroll through those, or it's a good group of stocks with a lot of different industries involved, right? And you can do the same thing with swing trading. Now, the people who take are subscribers to my research can easily take high biased upward stocks that have strong characteristics on their longer term time frames and wait for pullbacks to a rising 18 and then look for their entry on the hourly chart. So it's almost like what I'm doing there is instead of fishing in the ocean, all right, I'm giving you sort of a pond that has really big fish in it. All right, that's the idea behind the Wednesday report that I send out, which is I'm narrowing the list some. I'm not taking it down to just a couple. I'm taking it down to a smaller, more manageable list. And if your focus is swing trading, you should almost only be looking for stocks that have a rising 18 and we're getting a pullback to that 18. If you do that in stocks that have strong conditions underneath, then you really improve your chances for having success if you get a good trigger. All right. Now, if you do it with the options, that increases your odds even more. I think it's a little scary right now it seems like every 2 or 3 days we get some kind of a gap in one direction or the other. If it were always in the same direction, it might be different. But because we're getting, different movements, different gaps, sometimes up, sometimes down, I don't think it makes the conditions for swing trading very good. High volatility on the daily chart is not typically conducive to swing trading. However, if you do the options, you can manage the risk. Now, I will say one thing: when there's higher volatility, the options have higher premiums. All right, so you're going to have to figure out what time frame, how quickly you think a stock can move. A lot of that will depend on the shorter term time frame. I think you can probably go out a couple weeks, anywhere from 2 to 4 weeks in your trades for doing swing trades. If it's a really high quality setup and it looks like it's triggering pretty well on the hourly, then you only probably need to go out a couple weeks. And I think you can make that work. Again, you're managing the risk by the size of the trade that you would do in the stocks. And I think if you do that, then you have a much higher probability of having success swing trading. All right. Let me know if you have any questions. Thanks.